Welcome to this video on the 2007-2008 U.S. economic and housing crash. We will conduct a comprehensive examination of the causes, government interventions, and lasting social consequences of America's worst financial crisis since the Great Depression. This presentation is brought to you by Series of Thoughts as part of their Economic Education series. We begin with Chapter 1, the housing bubble and risky lending, which laid the foundation for the eventual economic collapse. The housing bubble peaked around 2006. U.S. home prices more than doubled from 1998 to 2006, fueling widespread economic optimism. The home ownership rate also rose dramatically to an unprecedented 69% by 2005. This confidence that, quote, housing prices never go down was catastrophically wrong. Between 2004 and 2006, subprime lending exploded, providing loans to borrowers with poor credit. Political pressure to expand homeownership led to systematically lowered underwriting standards. This included the use of liar loans, where income wasn't verified, enabling fraud and defaults. A key imbalance was the divergence between soaring home prices and stagnant wage growth. While housing values doubled, median household incomes increased by only 15%. Creative financing, however, masked this gap, allowing the bubble to inflate further. The market was filled with risky mortgage products and speculation. Adjustable rate mortgages, or ARMs, used low-quote teaser rates that borrowers could not afford when payments reset. Extreme leverage and a speculation frenzy, driven by investors looking to quote 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 quote. Chapter 2 explores financial innovation and institutional failures, detailing how risks were spread throughout the global financial system. The crisis was fueled by complex financial instruments like mortgage-backed securities and collateralized debt obligations. Mortgages were bundled, assigned misleadingly high safety ratings by agencies, and sold globally. This complex chain obscured risk, leading to cascading failures when defaults began. The financial crisis reached a tipping point with the Lehman Brothers collapse in September 2008. The largest U.S. bankruptcy triggered an immediate credit freeze, paralyzed markets, and caused global panic, requiring emergency bailouts for other institutions like AIG. The fall of Lehman Brothers, with over $600 billion in assets, symbolized the systemic breakdown. The image of employees carrying boxes from the headquarters became iconic, marking the end of unchecked financial expansion and the start of the deepest downturn since the 1930s. Regulatory and oversight failures allowed the crisis to accelerate. Regulators failed to monitor the shadow banking system, and banks operated with dangerously low capital reserves. Furthermore, rating agencies had conflicts of interest, giving high ratings to complex securities they didn't fully understand. Chapter 3 focuses on the government response and financial stabilization, examining the massive interventions that followed the market collapse. The Troubled Asset Relief Program, or TARP, was an emergency bailout authorized at $700 billion in October 2008. Though controversial, TARP successfully stabilized the banking system and the auto industry. The Treasury eventually recovered all funds plus interest, yielding $109 billion in profit. The American Recovery and Reinvestment Act of 2009 was an $800 billion stimulus package. It aimed to jumpstart growth through tax cuts, infrastructure spending, and aid to states. ARA also expanded the safety net, providing direct relief and preventing millions from falling into poverty. The Federal Reserve took unprecedented actions, slashing interest rates to zero and creating emergency lending programs. Most notably, the Fed launched quantitative easing, purchasing massive quantities of bonds to inject liquidity and lower long-term rates. The Fed also utilized forward guidance to shape market expectations. The chart illustrates the unprecedented expansion of the Federal Reserve's balance sheet. Starting below $1 trillion before the crisis, the Fed's aggressive asset purchases prevented a complete financial collapse and kept credit markets functioning. Government interventions in the housing market included placing Fannie Mae and Freddie Mac into conservatorship. Programs like the Home Affordable Modification Program and the Home Affordable Refinance Program were launched to prevent foreclosures and allow underwater borrowers to refinance. Chapter 4 explores the social impact and the safety net, focusing on the human toll of the Great Recession. The crisis resulted in massive job loss and economic hardship. Nearly 9 million Americans lost jobs, and the unemployment rate peaked at 10%. This fundamental shock altered millions of lives, causing an 8.1% decline in median household income and destroying middle-class wealth. The housing market fallout was severe. U.S. housing prices fell nearly 30% from the peak, and over 4 million homes were lost to foreclosure. American household net worth declined by $13 trillion, representing a staggering destruction of wealth. The social safety net expanded significantly to cope with the crisis. This included the expansion of SNAP enrollment, the extension of unemployment insurance benefits, and increased Medicaid support. These programs prevented poverty from rising even more dramatically, though gaps remained. Millions of ordinary Americans struggled to stay afloat, as symbolized by the long unemployment lines. The psychological toll of foreclosure and financial insecurity left deep scars, often resulting in a permanent downward shift in economic expectations. The long-term consequences include an unequal recovery and a widening of inequality. Employment finally returned to pre-crisis levels in 2014, but job quality declined. Millennials faced lasting wage penalties, and home ownership rates remained depressed. The primary reform effort was the Dodd-Frank Wall Street Reform Act, which created the Consumer Financial Protection Bureau, imposed higher capital requirements, and limited proprietary trading by banks. However, ongoing challenges remain regarding too-big-to-fail institutions and the shadow banking system. In conclusion, the 2007-2008 crash exposed systemic vulnerabilities. Aggressive government intervention prevented a depression, but could not prevent massive social hardship. Vigilance and robust oversight are essential to prevent future crises, making this history vital for future policy decisions.